As you assured me earlier, you don't want a big introduction, so I'm going to let you introduce yourself to the room, and then we'll get started. So thank you all for coming. Thank you especially to Brett for speaking with us tonight.
Thank you for that, Matt. Yeah, I mean, I don't want to do a long introduction at all. It's fantastic to be here. My first time in Christchurch, even though I actually lived in New Zealand for 3 years. I did my PhD in Auckland between 2005 and 2008, but we had very, very young kids at the time and we didn't venture very far. So yeah, it's a pleasure to be here, and it's a privilege to be here and to talk this evening. And yeah, as Matt said, I work at Uppsala University in Sweden. I'm a geographer by disciplinary affiliation, but most of my work is on, I guess, questions, principally in recent years, around questions of changing patterns, changing regimes of ownership of various types of assets in contemporary capitalism. In significant part in the UK, but not only there. And in the last couple of years, in terms of the types of assets that I've been focusing on, increasingly it's energy infrastructures, and with a particular focus on renewable energy infrastructures. And so that's some of the stuff we're going to be talking about this evening.
Okay, well, you talked about what you've done so far. The first kind of question I have is, why this? Why fossilised capital? You've written rentier capitalism, you've looked at wealth managers, asset managers. What's the link between your past work and your current and future work? So why are we talking about transition?
Okay, so I mean, partly I guess it's an issue that everyone's aware of, the energy transition, what it looks like, why it's going slower than it needs to be doing, and what form it takes, and so on. So there's a kind of a generic interest there. But so all the work I tend to do tends to emerge organically from previous work that I've done, and as you mentioned, I've been doing some work on asset management firms. So lots of the names people will be familiar with: Blackstone, BlackRock, Macquarie from Australia. And while I was doing that work, one of the things that I noticed was that those firms have been increasingly investing in infrastructure assets in recent times, of various different types. But the area of, I guess, the fastest growth of investment in infrastructure among asset management firms in the past 5 to 10 years or so has been renewable energy infrastructures. So it was while I was doing the work on asset management that I became aware that renewable energy was this like big focal point of investment for these asset management groups. And so, it was just literally a case of emerging from one project and thinking, right, I need to start looking at this and trying to understand what's going on there.
Okay, and so the paper that I read as preparation for tonight, and that is in the title of this talk, is Fossilised Capital. Right? And you talked about that. So first of all, could we talk about fossil capital and then the move that you've made from fossil capital to fossilised capital? So what is fossil capital?
Yeah. Is that working still? Yeah. So fossil capital is a term that many people in the room might have heard, but I'm guessing quite a few people may not have heard of it. So it's a term that I have no idea if it originated with him, but I first became aware of that term by reading the work of Andreas Malm, who is someone that I'm sure lots of people in the room have heard of and are maybe familiar with some of his work. He's a Swedish academic, activist, who's been very prominent, particularly in recent years. His most recent book, that's now a movie, called How to Blow Up a Pipeline, which is about talking about changing tactics of activism around climate questions. But the book that first brought him sort of a degree of significant attention, at least within academia, was his book that was titled Fossil Capital, and it's a book about many things, but principally it's a book about the transition to fossil fuels in early industrial capitalism. So he focuses on the period right at the end of the 18th century, beginning of the 19th century, and specifically focusing on northwest England and the beginning of the Industrial Revolution. And it addresses the question of why, particularly within the cotton industry, but increasingly within other industries around that time, why cotton capitalists transitioned from water and the water wheel to steam and coal. And so why it was that capital became fossil capital, in other words. So he basically makes this argument that fossil capital, which is to say capitalism that's fundamentally attached to fossil fuels as its main energy source, why it emerged during that period. And he basically argues that ever since then, capital has been fossil capital. Fossil fuels and capitalism have been joined at the hip ever since that particular period. So that's the term that he uses. I think it's a very, evocative and powerful term.
Okay, and then the move in your paper to fossilised capital?
Yeah, partly it's just a kind of trying to use a comparable term that's not exactly the same term. But the basic argument, and we can talk about the kind of the granularities in the argument as we go forward. But the basic argument I make is that just as there was an energy transition that occurred during that period in early industrial England to fossil fuels, so capitalism became as I said, joined at their hip to fossil fuels in that period. There's an energy transition occurring now, or is an energy transition that we need to be occurring now, but it's not occurring on the scale and on the pace and in the way that it needs to do. So I basically suggest that there's something about capital today that has kind of rendered it fossilised. It's like stuck on the fossil fuels. So just as capital became attached kind of limpet-like to fossil fuels in that period, it remains kind of stuck on fossil fuels today. And I guess all I was trying to do there was draw on Malm's term, but change the terminology a little bit to suggest we're not talking about why capital became attached to fossil fuels in the first place, but why it's struggling to kind of unattach itself from fossil fuels today. Yeah.
So, what you've mentioned a few things, but what specifically do you think we should think about today for the next transition that is necessary? What can we learn from, either for better or for worse, from the transition into fossil capital?
Yeah, and that's a good question. And so the basic argument that I make in that paper, and that I've been trying to work with in other work that I've been doing, is almost like a mirror image of Malm's argument. So I don't know how many of you are familiar with that argument, but Malm's basic argument is that he kind of takes to task traditional economic historians of the Industrial Revolution and what was going on in energy terms. So there's, not surprisingly, there's a voluminous literature out there that's existed for many decades that asks the question of why that transition to fossil fuels took place. And as Malm shows in his book, there's a whole wide range of arguments that economic historians have given for that. But the principal one comes down to the question of price. And so that argument has traditionally been that cotton capitalists moved to steam and therefore coal and therefore fossil fuels because they were cheaper. So that's the basic argument that has traditionally made. And actually, if you look at the kind of historiography of energy transitions more broadly, not just that particular energy transition, but the whole literature on energy transitions historically is dominated by price arguments. That energy transitions only occur if and when a new energy source is basically cheaper than an existing energy source. And Malm basically rejects that argument. So he looks at the record, and first of all, he goes through a lot of the data that he could find for that period, and he finds that actually steam and coal were not cheaper than water and the water. Well, they are actually more expensive, and they remain more expensive for quite a significant period of time. And so his argument is basically different. And he says, look, if you look at the economics of what was going on there, the actual reason that the transition occurred was not that steam and coal were cheaper, but they were more profitable, which is to say that they rendered production more profitable than it was underwater in the water wheel. And it's quite a sophisticated argument, actually, and there's some, for a geographer like me, there's some really interesting arguments about the spatiality of production and why the relative profitability of fossil fuels in cotton production was shaped by the geography of production, but also the temporality of production and the timescales of production. So that's his basic argument that he makes at that time. And so the argument I've been trying to make, and that I laid out in the article, but I'm also working on trying to extend it, is that actually if you look at what's going on with the energy transition today, there's actually a remarkably similar set of questions and arguments that potentially one can make, because if you read the mainstream press and if you listen to mainstream economic commentators talk about the energy transition, talk about the transition from fossil fuels to renewables, today what they long said was that renewables would struggle to supplant fossil fuels because they were more expensive. And they also said that once renewables had become economically competitive on price, on cost with fossil fuels, and once they had actually become cheaper than fossil fuels, then we would suddenly see this kind of massive, rapid shift into renewables and away from fossil fuels. Now, the issue, particularly if you look at electricity, which is the area I've been focusing on, I can explain in a minute why I focus on the question of electricity. But if you look at what's happening, it's actually been the case for 3 or 4 years now, at least, that renewable energy generation is economically competitive on price with fossil fuels. You can generate electricity from solar and wind more cheaply now in most countries of the world than you can from gas or coal, the main fossil fuel sources of electricity. But still, the transition is not happening at anything like the pace we need it to. And just as importantly, the argument will always look, while renewables are more expensive, governments will need to continue to subsidise renewables. You will continue to need to have governments intervening in energy markets to support renewables because they're more expensive than fossil fuels. But the argument was always like, look, once they're competitive on price or cheaper to generate electricity from renewables than from gas or coal, you can safely remove that government support, you can remove the subsidy mechanisms because they can compete on their own terms. But actually, if you look around the world today, in any country you care to look at, from China to Australia, from Germany to the USA, renewable development is still completely dependent upon government support of one type or another. And I can talk about the different types of support. And so the argument I've been making is actually, just as was the case back in the early 19th century, it's not about price, it's about profitability. And the issue remains today, and the issue today is that if cotton production was more profitable using fossil fuels in the early 19th century than it was using water and the water wheel, then generating electricity from solar and wind today is simply not compelling enough a proposition in profitability terms. The returns from investing in renewable energy are not attractive enough to drive the pace and speed and scale of transition that we need. And that's obviously a problem. I'll shut up in a minute and let you intervene. But the problem we have around the world is that essentially most governments around the world, and you can argue whether this is true in China or not, but most governments around the world have outsourced the energy transition to the private sector. They've basically said, look, we'll provide various forms of support under certain circumstances, we'll issue certain types of feed-in tariffs or whatever else it might be. But basically, we are expecting the private sector to lead the energy transition. We're expecting private sector firms to build and operate the wind and solar farms that we need. Now, if that's the political economic approach that's been taken, then obviously you have a fundamental problem if profitability is not attractive enough to encourage private sector actors to invest at scale in the renewable energy sector. So that's the basic argument I've been making. And just as a kind of qualifying point, that those arguments are focused specifically on electricity generation, and I guess the reason for that is that carbon dioxide is the main source of fossil fuel emissions, and the combustion of fossil fuels is the main source of carbon dioxide emissions, and electricity generation is the leading source of combustion of fossil fuels. So that's so electricity is at the very heart of the energy transition.
Okay, so why are fossil fuels at this point more profitable than renewables?
So that's a complicated question. There's lots of aspects to it, but I'll point to. I'll say two things in relation to that. So the first thing to say is that in saying that renewable energy is a business in which governments around the world remain fundamentally involved across the board in providing various forms of subsidy. That's absolutely not to say that they also don't provide forms of subsidy in relation to fossil fuels, because of course they do. They provide subsidies to companies in terms of fossil fuel extraction and exploration, and they provide much more so subsidies on the consumer side to fossil fuels as well. Subsidies to consumption are by far the biggest source of fossil fuel subsidies. So you get subsidies on that side as well. But I would argue the main issue why oil and gas extraction and exploration on the one hand have long been much more profitable and remain much more profitable than electricity generation from renewables is that you have much more robust and dependable sources of monopoly power in the fossil fuel sector, which in large part internationally is a question of OPEC, right? I mean, OPEC is a cartel that with any sign of reduction in oil and gas prices worldwide, they call for declining production of oil and gas simply to keep up prices and profits. And in electricity generation in general, but within electricity generation among solar and wind farms in particular, there is essentially no monopoly power. There's very, very limited barriers to entry. Essentially anyone can become an electricity generator on one scale or another. And what that means is that prices get pushed down very, 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 very intensely once you get lots of new investment coming in. And that simply isn't the case in the oil and gas sector. So the monopoly, economists have known for generations that there's a close relationship between monopoly power on the one hand and monopoly pricing and profits on the other. And that's a core feature of the fossil fuel world of oil and gas exploration and production. But it's simply not a significant feature of renewable energy generation on the other. So that's one thing I would say is that there's a very important relationship to do with monopoly and competition and relative degrees of competition in different parts of the energy economy. I think the other thing I would say is that the barrier to and actually, just to put some figures to this, for example, if you look at companies like BP and Shell, for example, and many of you might have read some of this stuff in the press in the last 6 months. So unlike the big US oil and gas majors, the likes of Exxon and Chevron, and unlike the big petro-state companies like Saudi Aramco in Saudi Arabia, the European oil and gas majors, so BP, Shell and Total, up to relatively recently, were talking a relatively good game on renewables. So they particularly in 2020, they came out and said, look, we realised that we have some problem. That climate change is a real problem. It's a real issue. We acknowledge its existence. We know that we need to change what we do. We know that we can't continue to be hydrocarbon companies ad infinitum. So what we're going to do is our long-term strategy is to transition away from fossil fuels into low carbon sources of energy generation and distribution in general, and renewables in particular. So they talked a good game on this. But one thing they've learned over the last couple of years is that the profitability in electricity generation in solar and wind is vastly lower than the types of economic returns to which they're used. And so actually recently they've pivoted back and said, actually, we're not going to be expanding our renewables operations as much as we can. And so just to give you an example of some of the figures, most people say, and this is what BP and Shell have found, but renewable energy companies have been saying this for years. Returns are normally around kind of 5 to 6 to 7 to 8% in renewables. That's the sort of level we're looking at. Whereas BP and Shell traditionally have been used to returns of 15% plus in their core businesses. So looking at it from a pure economic perspective, why would you transition away from something that's exceptionally profitable to something that's much less profitable? And their shareholders have been putting a lot of pressure on them asking those types of questions. So BP and Shell have kind of have sort of thrown significant light on this question about the relative profitability of the two different businesses. The only thing I'll add to that, and as I say, a lot of that's to do with questions of monopoly and competition. But the other thing that's really important to understand about solar and wind that I definitely personally didn't understand before getting into this work is that not only is profitability be relatively low, but it's actually incredibly, all other things being equal, it's actually incredibly difficult to predict ahead of time how profitable it's going to be. And there are lots of reasons for that. But the main reason for that is that electricity prices are incredibly volatile. So if you look at the pricing of different commodities around the world, I don't think there's any commodity where the price of that commodity is as volatile over both long and short time periods as it is in electricity. And there's all sorts of reasons for that that I won't get into, but I'll be happy to talk about later. But it's incredibly volatile. The price of electricity can increase tenfold in the space of an hour, for example. It's unbelievably volatile. And what that means is that that is enormously significant in terms of what happens when renewables developers want to develop a new wind or solar farm. So imagine you're a renewables developer and you found a piece of land and you think you can connect some new wind turbines to the grid and sell your electricity. Well, to build 4 or 5 turbines, it might cost you, say, $50 or $100 million. Where are you going to get the capital from? You go to the bank, and the bank says, okay, how much money are you going to earn from selling the electricity? And you say, well, it depends. And you show them these graphs of volatile electricity prices, and they say, there's no way we're going to lend you money to build that. Because if electricity prices are, $10 per megawatt hour over the next 5 to 10 years, you're never going to be able to pay back your loan. And yes, if electricity prices are $100 per megawatt hour over the next 10 years, you'll be able to pay it back within 2 years. But nobody can predict electricity prices ahead of time. And so that price volatility exerts an enormously important chilling effect on investment in renewables. And the result of that, and this kind of comes back to what I've been trying to say about I don't know if any of you have heard the announcement yesterday from the New Zealand government about its relationship with BlackRock. So one of the things I've been trying to say when I've been talking to people in the media the last couple of days is that because of that volatility, no company, and certainly not BlackRock, is going to invest in solar and wind farms anywhere in the world, including in New Zealand, unless it knows that there are mechanisms to mitigate that price volatility going forward, which normally means some form of government support or subsidy or guarantee of some form or another. And it's precisely those mechanisms that no information has been given about by the New Zealand government in relation to the BlackRock case.
Well, you've answered almost all my questions. That's rendering me useless. But I might just throw you a little bit of a curveball that I didn't prepare you for. But you wrote it really explicitly in the paper that production comes before consumption, right? And a lot of like liberal theories are about consumption. We can consume our way out of the crisis if we just make responsible or ethical decisions, right? What does production come before consumption means, and what are the implications for?
Was it me that wrote that? I didn't know I wrote that. That sounds like a Matt Huber sort of thing to say rather than me. I mean, the argument. That's. Yeah, I have. To be honest, I mean, this is not directly related to my piece, but I think it's a really important question, so I want to talk about it because, and many of you will have heard this argument, and many of you possibly will completely subscribe to this argument. So there's a strong argument out there and there's a book that, again, many of you might have heard of or read, called Climate Change as Class War by Matt Huber, who's another geographer. And his basic argument in that book, I think it came out last year, his basic argument in that book, as I understand it, is, look, we need to sort of ignore those people who say that consumption has a significant, and consumption behaviours have a significant role to play in climate change mitigation. So his argument is that's kind of a fig leaf that's been constructed by the fossil fuel industry to kind of divert responsibility from themselves and say, look, it's all about your own individual carbon footprints, and you need to change your behaviour, and we're just responding to that demand that you continue to generate, and we're just meeting that demand. So it's about consumption rather than production. And Matt said, well, actually, that's just a deflection tactic, and actually we should look at those who are responsible for taking the oil and gas out of the ground and creating particular consumption behaviours and consumption patterns. And I think the argument that Matt makes is something that he would take out of classical political economy in general, and Marx in particular, would be that production comes before consumption, not just in temporal terms, but also in kind of functional terms as well. Yeah, I mean, I think Matt's right. I think he's absolutely right, but I also I'm much less of a kind of dogmatist than he is on those points. I think that consumption is important. I think that, and I think history shows that, you know, you look at things like anti-apartheid protests and so on. I think history shows that actually consumption can play a very significant role. I think consumption and production exist in a much more kind of dialectical relationship than Matt would allow, actually. And I also think, and this is the thing that I make myself really unpopular when I say this, but I'll say it anyway, I also think that argument's become a fig leaf for kind of people on the left who don't want to change the way they live. I mean, I know loads of academics who are like, well, yeah, I'm going to continue to travel to loads of conferences around the world. I mean, I know I'm over here on the other side of the world. But I'm also doing about 20 events while I'm here in 2 weeks, rather than flying around the world to give a 15-minute presentation. But they're like, yeah, you know, it's all about we just need system change, and my individual behaviours don't make any difference. And I fundamentally disagree with that argument. I think that it needs people in positions of influence, not that I have any influence, but climate scientists, for example. I think the way they behave in their own consumption, it can make a massive difference. And I think that it's become a fig leaf for people who enjoy their luxuries, who don't want to give it up, to say we need system change. Of course we need system change, but I refute the argument that behavioural change has no part to play in shaping system change in terms of systems of production. But that's just my view.
Thank you. And so let's talk a little bit about finance.
Yes.
We can probably, this. I thought I was going to blow Brett's mind with this announcement yesterday, but he spent all of yesterday in the media talking about it. American investor BlackRock to launch $2 billion clean energy fund in New Zealand. So outsourcing transition to finance.
Yeah.
Let's talk about that a little bit.
Yeah. I mean, I'll make a couple of general points before getting onto the case of BlackRock in particular, which is a fascinating example. I think the general point I'd make is that finance is incredibly important when it comes to the question of renewable energy. Much more important than I'd ever imagined would be the case. I mean, finance is important in every industry, right? No industry can exist without financial support, borrowing, investment of one kind or another. But it's particularly important in renewable energy. And there's a couple of good reasons for that. But the main reason for that is if you think about the cost structure of renewables. In renewables, unlike in oil and gas, unlike, for example, if you're operating a gas-fired power plant or a coal-fired power plant, in renewables, almost all your costs. In renewables, essentially all your costs, for the most part, come right at the beginning, before you generate a single watt or megawatt hour of electricity.
That's different from in fossil fuels. So if you're a fossil fuel plant operator, your main costs are your fuels. The main cost is the gas and the coal that you need to run that plant. And you continue to incur those costs throughout the life, the 30 or 40 year life of the plant. But with renewables, all the cost is up front. And once the wind turbine is built or the solar modules are installed, you have almost no cost. There are no fuel costs at all. You might need a little bit of operating and maintenance cost if the blades stop turning. You need to send someone up to fix it. But essentially, over 95% of the costs come up front. And what that means is that it's an incredibly capital-intensive business where you need a huge amount of financing up front at the beginning, and then essentially the whole economics of the business is the amortization of those costs over the 25-year life of the plant. And and what that essentially means is that the people who decide whether solar and gas, I mean, this was kind of probably my main insight, it's not a particularly revolutionary insight, but the people who actually decide whether and when and where solar and wind facilities get built are not renewables developers, it's the financiers. It's bankers who basically decide whether those facilities get built, because they're the ones who have to supply the financing that provides that, and that's kind of the key choke point. I mean, there are various other things that renewables developers have to sort out before they can start building. They have to arrange a grid connection. They have to either buy the land or lease the land. They have to get environmental permits, and show they're not going to be overly destructive to local bird life, for example, in the case of wind farms. But the key choke point, the thing on which if a project is going to fail, the point on which it fails 90% of the time is raising finance, because there's, again, and this comes to a point of competition. There's way more willing wind and solar farm developers out there trying to develop wind and solar farms than there are financiers willing to supply the financing to that. So to understand, that's a kind of a long way of saying something short, which is to understand renewables, you have to understand finance, and I guess that's where BlackRock comes in. So again, just for people who didn't hear the announcement, there was a great fanfare from the New Zealand government yesterday, saying that BlackRock, and I'll talk a little bit in a second about what BlackRock is, because there's loads of, it's one of those entities around which there's a lot of kind of myth and mystification. But BlackRock came and said, and it was announced yesterday, that BlackRock will be establishing an investment fund worth, I think, up to $2 billion for investments specifically in speeding New Zealand towards 100% renewable electricity generation. So that was the announcement, and it's been presented absolutely as a win-win for everyone involved, and it may yet be that, but I think that it's impossible to say that based upon the information that's been released so far. So BlackRock, and again, for those who know all this, I apologise for stating the obvious, but BlackRock is an asset management firm. Asset managers are a particular type of investment company. That what distinguishes them from other types of investment companies is that most of the money that they invest is not their own. So that's why they're called managers. They manage other people's assets, other people's money. And so about until the 1990s or so, asset managers like BlackRock, almost all the investment, or in fact all the investment they carried out, they invested in financial assets, so stocks and bonds, municipal bonds, corporate bonds, government bonds, and so on. In the 1990s, cutting a long story very, very short, they began also investing directly in physical real assets, things like housing, things like commercial real estate, transportation infrastructures, energy infrastructures, telecommunications infrastructures, and so on. And so the way they do that is that if they want to invest in infrastructure, they'll set up an investment fund. So they'll say, we're going to establish this fund. Its specialty is going to be investing in transportation infrastructures in Southeast Asia, or telecommunications infrastructures in North America. And they'll go on the road, where they'll go and visit the trustees of big pension schemes, executives of insurance companies and so on. They'll say, okay, we're setting up this fund. We think this fund's going to generate significant returns. Why don't you give us 100 million of your pension pot to invest in that fund? When the fund is wound up in 10 years' time, we'll return that investment to you with a big healthy profit, and you pay us fees for doing that. That's the basics of the model. So that's what BlackRock is basically saying it's going to do in New Zealand. It's going to raise a fund, hasn't raised it yet. It's going to go on the road. It's going to tell investors, we're going to set up this fund. It's going to invest in renewables in New Zealand. It's going to make fat, juicy profits. We want you collectively, our clients, to give us $2 billion to invest, and we'll generate a 10% annual return, 12% annual return after fees, and that's our promise. And so something like, I think on average, about 98% of the money that BlackRock and its peers raise in these types of infrastructure funds is money that's given to them by others. And about 2% is their own money, usually. So they raise capital by others, try and generate a profit for them and earn fees in the process. So that's what they're saying they're going to do in New Zealand. They're going to make big, juicy profits for their investors who are going to give them $2 billion by investing in renewables in New Zealand. And the only significant point I think I would make about that is let's wait and see what the terms and conditions are under which that investment will take place. And the reason I say that goes back to exactly what I've been talking about this evening, which is that, you know, you wouldn't guess it from what the government's been saying, but renewables is a really risky business. So would BlackRock be coming here and saying we're going to invest $2 billion without some form of risk mitigation, without some form of confidence that we're not going to be selling electricity in a market where electricity prices are going to suddenly dive to $10 per megawatt hour? There's no way they're going to do that. So undoubtedly there will have been some discussions with the government where BlackRock will have said, look, we're happy to do this fund, happy to commit our investment to New Zealand, but there has to be some form of subsidy, there has to be some form of guarantee, there has to be some form of kind of first loss taking by Crown agencies or whatever else it might be, that means that essentially BlackRock is guaranteed a profit and is not actually absorbing much in the way of risk in the process, because that's the way it works everywhere in the world, and it won't be any different here.
Okay, how are we doing for time, Tom?
It's 7:45.
7:45, yeah. So we've got one more question, then we're going to have a drinks break, and then we'll open up to the room. Yeah. So I'll give you a choice of 2 questions.
Okay.
I'll take the easier one.
Okay. So the first one, in terms probably familiar to the room, what is to be done? And the second one, is there anything else you'd like to talk about while we're here?
I'll take the first one. I mean, so in the longer piece that I've been writing about this, the way I put it is basically this: is that the reality is that governments around the world, as I said earlier, have effectively contracted out the energy transition to capital, and they have continued to support that transition through a whole array of financial support mechanisms, which mean actually a large amount of government investment has been going into this for a long time, and it continues to go into it. And crucially, that remains the case, even though the prices of the underlying technologies, the prices of the turbines and the solar panels, largely thanks to innovation in China, which is where all the innovation has been taking place for the most part, even though those prices have come down, and even though we were kind of promised that once prices came down, governments would be able to safely withdraw support and investment would continue. But all the evidence shows on the rare occasions when they have withdrawn support, investment collapses. It utterly collapses when they withdraw subsidies and supports. So if that's the case, what should we do? Well, one set of arguments will be we just carry on as we are. We just accept that the governments will continue to have to subsidise it and support it ad infinitum, and we just kind of accept that. And you know what? Maybe we should. You know, if someone gave me a choice between the investment happening and the transition proceeding and BlackRock making a shitload of profit and the investment not happening because governments withdraw support and the transition petering out, I'd take the first every day of the week, right? I mean, a transition plus BlackRock profits is better than no transition and no BlackRock profits. But the alternative, I guess, I raise in the book, and I don't particularly offer an answer because I'm not very good at offering answers, I'm better at pointing out problems. The alternative would say, well, if governments are making all this investment and bearing all this risk and absorbing all this risk, despite capital having been given the opportunity to do it themselves and not wanting to do it themselves because of the risks involved, and if that's still the case, despite prices having come down, the cost of the technology coming down as far as they can, then maybe relying on capital wasn't the right model in the first place. And maybe governments actually, I mean, governments have not always been the best custodian of various forms of infrastructure, utility infrastructure of various kinds, but it's not that complicated a business. Maybe governments, instead of bearing all the risks, should actually invest and bear the risk and generate the reward, like and own the facilities. So publicly owned renewable power strikes me as something that pretty obviously should be a significant part of the solution. And you know, I will allow that there are certainly parts of the world in poorer countries where there are very, very real and significant fiscal constraints on governments that can't borrow at anything other than utterly punitive rates to carry out that type of investment. But New Zealand is not in that situation, and North America is not in that situation. Nowhere in Europe or Northern Europe is in that situation. So I think clearly there are places in the world where governments could quite happily borrow very, very cheaply, much more cheaply than private sector actors can, to undertake that type of investment and own that type of investment themselves. So that's, I guess, what I would say, which is I think there's a very obvious solution, but it's a solution that is beyond the political pale in most parts of the world with which I'm familiar. And I mean, in the US, there have been, a couple of notable in New York State now. There's been essentially new legislation passed that enables a kind of revivification of publicly owned power plants in renewables, but they're tiny, tiny wins, and they're all heavily caveated.
So nationalise the transition is a possibility.
I mean, a proper green, like essentially the proper new Green New Deal that was, I mean, it's become massively watered down now, but in the form in which it was originally articulated by both Corbyn and by Bernie Sanders in the US, publicly owned energy, and especially publicly owned renewable energy, was right at the heart of that, but it's disappeared.
Okay, well, that last section raised a whole lot of new questions for me, but I'm no longer going to monopolise the Q&A. So we'll take a little break and get some more drinks if we want.
Come back at 8 o'clock.
I think come back at 8 o'clock and prepare your questions, and we'll carry on a little bit. Yep, thank you so much.